Think about how trading has changed, hasn't it? I mean, from shouting orders across a trading floor to, well, now it's the silent hum of computers.
Yeah, executing millions of transactions.
And you, our listener, you've likely seen this shift towards automation in, all sorts of parts of our lives.
Mm-hmm. But what's truly fascinating is the cutting edge of this. High-frequency trading, or HFT.
Right.
We're talking about a world where technology enables trading at speeds and scales that were pure science fiction just a little while ago.
Exactly.
Right.
And to really get a handle on this, we've been diving into Irene Aldridge's book, High Frequency Trading.
Great resource.
Definitely.
Yeah.
Think of this as your shortcut to understanding the essentials. Our goal here in this deep dive is basically to pull out the core knowledge of what HFT is, how it works, and importantly, why it matters in today's markets.
Yeah, without getting totally bogged down in the super technical weeds.
Hopefully.
Yeah.
So in this exploration, we'll first map out the landscape, right? The developments that led to HFT and its current structure.
Then we'll get into the trading methods, the actual strategies, comparing them to maybe more traditional approaches.
And finally, we'll look at the tech, the crucial technological backbone that makes it all tick.
Sounds like a plan.
Okay, let's start by unpacking this landscape.
Mm-hmm.
HFT didn't just appear out of nowhere, did it? There's a backstory.
Precisely. No, it evolved. The increasing reliance on systematic trading, trading based on rules and algorithms, that was a major step.
Mm-hmm.
And this trend really picked up steam alongside tech advancements. A key moment, really, was back in '92. The launch of the Chicago Mercantile Exchange's electronic platform, Globex.
Globex, right. I remember that.
Yeah, initially it was just futures for a few major currencies, but its impact on futures trading.
Mm-hmm.
Immediate, profound. It really set the stage for automation everywhere else.
It's just incredible when you think about the sheer growth and volume, too. The book points out the NYSE went from maybe 1 million shares traded daily back in 1923
Wow, 1 million.
to over 1 billion in 2003.
That's just astronomical. And that surge really underscores the need for faster, more efficient ways to trade.
Makes sense.
And alongside this, the structure of the financial services industry itself, it changed dramatically. The old hierarchical model started to flatten out, becoming more of a decentralized network in the late 90s.
Okay, so when you talk about this decentralized network, who are the main players?
Yeah.
Still the exchanges?
Primarily, yes, you still have exchanges as the central places for matching and clearing orders. But especially in the foreign exchange market, interdealer networks became absolutely vital.
Interdealer networks.
Yeah, often run by interdeal brokers, they provided essential liquidity by connecting banks and broker-dealers. Interestingly, investment banks initially had to kind of go through commercial banks for their FX trades.
Huh. Okay. Now, within HFT itself, it's not just one thing, is it? The book breaks it down into, 4 main types of strategies?
That's right, yeah. Table 1.1 lays them out. First is automated liquidity provision.
Yeah.
Here, HFT firms are constantly posting both bid and ask prices. They're basically acting like market makers.
So buying and selling constantly.
Exactly, and profiting from the spread, that tiny difference between the buy and sell price. Holding periods? Very short, often less than 10 minutes. The idea is making money by always being there to trade for a tiny fee.
Okay, got it. They provide the liquidity, capture the spread. What's next?
Second is market microstructure trading. This is about exploiting really short-term price discrepancies, tiny inefficiencies in how the market works.
Mm-hmm.
Again, the time frame is usually under 10 minutes. It relies purely on speed to grab these fleeting opportunities that, slower traders would just completely miss.
So tiny imbalances they can jump on super quickly. Makes sense. What about the other two?
Third one is event trading. This involves short-term trading around big macroeconomic events or news releases.
Like jobs numbers or inflation reports?
Exactly. The horizon is a bit longer here, maybe under an hour, but the core idea is reacting instantly or even anticipating how that news will hit the market.
Okay, reacting almost instantaneously. Got it. And the last one.
The final category is deviations arbitrage. This is more statistical. Exploiting deviations from what's considered the equilibrium price or relationship between assets.
Statistical arbitrage.
Yeah, things like triangle trades or basis trades. The holding period can stretch a bit longer here, maybe up to a day sometimes. They're capitalizing on mispricings that most people wouldn't even notice, betting that things will eventually snap back into line.
It sounds like a very sophisticated, very fast-paced game. Who are the big players doing this?
Well, the book mentions proprietary trading desks within the big banks, although sometimes the really successful HFT units get spun off into their own hedge funds.
Right.
And then you have specialized, dedicated, high-frequency trading firms. As for who invests in HFT funds, you see fund of funds, other hedge funds adding HFT strategies, and even private equity.
And they need serious resources, I assume. Serious capital.
Absolutely. Most investment banks offer what they call prime services. That's basically providing leverage, clearing, and other critical infrastructure. Leverage is vital because the margins on each trade are often tiny, so you need volume and leverage to make it worthwhile.
And then there's a whole support system.
Oh yeah, a whole ecosystem of service and technology providers.
Yeah.
Data feeds, hardware, software, network connectivity, it's all essential.
Okay, so that gives us a good picture of the playing field. Now, let's shift gears. How does HFT actually trade?
Mm.
How is it different from, say, the way people used to trade?
That's a really crucial distinction. Traditional trading, broadly speaking, often relied on either technical analysis or fundamental analysis.
Right. Charts versus company value.
Pretty much. Technical analysis, looking for patterns and price charts, using things like moving averages, mass DD.
Head and shoulders patterns.
Exactly. The idea was if enough traders believed in these patterns, maybe they'd become self-fulfilling prophecies.
But the book suggests that's maybe not so effective now, at least for HFT.
That's right. I mean, technical analysis might still hold some water for really small illiquid stocks that trade, once in a blue moon,
Uh-huh.
but for liquid securities, at the lower frequencies most people look at, its effectiveness has really diminished. Big institutions have been using computers to model and trade away those patterns for years. They often disappear before a human trader could even spot them.
Okay, so technical analysis is largely out for HFT. What about fundamental analysis, looking at the underlying value?
Right. Fundamental analysis started mainly in stocks, focusing on things like future dividends discounted back to today's value. Graham and Dodd were the pioneers there.
The classics.
Yep. Over time, it expanded to other assets, even those without obvious cash flows, using expected economic variables. So for currencies, fundamental analysis looks at inflation, trade balances, interest rates, trying to figure out that fair exchange rate.
So both technical and fundamental analysis have been around ages. Where does HFT fit compared to those?
Well, given the speed and the sheer volume of data HFT deals with, neither of those traditional approaches really works on its own, certainly not in real time.
Right.
Algorithmic trading isn't just helpful for HFT, it's absolutely necessary. Evaluating every single price tick, processing news feeds instantly, making consistent, unemotional decisions in milliseconds. That's just beyond human capacity.
So the algorithms are the engine.
Totally. Affordable, powerful algorithms are what make HFT possible.
Okay, algorithms do the heavy lifting. But how do they actually place the trades? What kinds of orders are they using? Market orders, limit orders.
Order types are critical, yeah. You've got market orders, which are basically get me in or get me out right now at the best available price.
Okay.
The book has a good example showing a market sell order just eating through the buy orders at different price levels until it's filled. So you get execution certainty, you'll trade, but you don't necessarily know the exact price beforehand.
Right, you take whatever the market is offering at that instant. What's the alternative?
That would be a limit order. With a limit order, you specify the price you're willing to pay or the price you're willing to sell at or better.
So you set your price.
Exactly. If there's a matching order on the other side at your price or better when your order arrives, bam, it can execute immediately. If not, your order just sits there in the limit order book waiting.
So it might not execute right away, or maybe not at all.
Precisely. With limit orders, you have price certainty. You won't get a worse price than you specified, but you don't have execution certainty. It's the fundamental trade-off. Speed versus price.
Market for speed, limit for price. Makes sense. Are there other important order types for HFT?
Yeah, the duration matters too. You have orders like good till canceled, GTC, or good till date, GTD, which stay active for a long time. Day orders expire at the end of the trading day.
Standard stuff.
But for HFT good till time, GTT orders are really useful. These let you set a very short lifespan down to the second.
Oh, interesting. Why is that useful?
Well, think about markets like options where they might charge you a fee to cancel or change an order.
Right?
With the GTT order, it might be cheaper to just let it expire in a few seconds if the market moves against you, rather than actively canceling it and paying a fee.
Clever. Avoid the fees.
Exactly. And the book also notes that stop loss and take profit orders are super common in FX spot trading, setting automatic exit points.
It's fascinating how even the order type and its duration become strategic choices. This all seems geared towards finding some edge, some inefficiency. How does the idea of market efficiency fit in?
Market efficiency is a really core concept here. The idea, in its purest form, is that prices should instantly reflect all available information.
Meaning no free lunches?
Basically, yeah. If a market is perfectly efficient, you can't consistently make profits without taking on risk or having illegal inside information. Paul Samuelson famously said back in '65 that prices in an efficient market should fluctuate randomly, the martingale hypothesis. Price changes are unpredictable, like a random walk.
So if markets were perfectly efficient, HFT wouldn't work.
Well, not exactly. While perfect efficiency might be the theoretical ideal, HFT operates on the premise that tiny, very short-lived inefficiencies pop up all the time, especially at high frequencies.
Oh, okay.
They're looking for those minuscule deviations from the theoretical fair price and trying to grab them before they vanish, which might be in milliseconds. The book mentions tests like random walk tests and co-integration tests that economists use to see how efficient markets actually are, or if there's any predictable pattern hiding in there.
Okay, so HFT is basically hunting for those fleeting cracks in market efficiency. How do their strategies actually find these opportunities using all that tick data?
They slice and dice that tick data in countless ways.
Yeah.
Simple stuff like calculating returns, both simple and log returns, is fundamental. They obviously look at volatility variance, standard deviation.
So prices are bouncing around.
Right. But they go way deeper, analyzing higher moments like skewness and kurtosis.
Okay, what do those tell you?
Skewness tells you if the returns are lopsided, if big moves are more likely in one direction than the other. Kurtosis tells you about the fat tails, the likelihood of extreme outlier events happening more often than a normal bell curve would suggest. And these characteristics can change a lot depending on the time frequency you're looking at.
So it's not just how much prices move, but the shape of those movements.
Yeah.
What else?
Autocorrelation is huge. This helps them see if there's any momentum. A price increase likely followed by another increase, or mean reversion, an increase likely followed by a decrease.
Patterns in the sequence of price changes.
Exactly. Is there a trend, or do prices tend to snap back? They use statistical tests, like the T-ratio or the Junbox test, to make sure any pattern they see isn't just random chance.
So they're trying to predict the very next price move, essentially.
In a statistical sense, yes. And they use models for this. Autoregressive AR models look at past prices to predict the next price. Moving average MA models look at past prediction errors. To see how different securities influence each other, they might use things like error correction models, ECM, or Granger causality tests. Does the price change in stock A help predict the price change in stock B?
And volatility itself, they model that too, right? Not just measure it.
Oh, absolutely. They don't just use simple historical volatility. They use more dynamic measures like exponentially weighted moving average, EWMA, which gives more weight to recent data, or realized volatility, RV, which is calculated from high-frequency data itself.
Trying to get a better read on current conditions.
Exactly.
Yeah.
And for even more complex stuff, they might dip into nonlinear forecasting models. The book briefly mentions things like Taylor series expansions, threshold models, even neural networks.
Wow, that is a ton of analysis happening incredibly fast. The book also mentions the quality of the tick data itself. I imagine that's absolutely critical.
It is. Massive volumes of data, but quality can be an issue. Centralized exchanges usually provide pretty reliable data bids, asks, trades, volumes, accurate timestamps. But in decentralized markets like FX, there's no single source of truth. Different dealers have their own quotes. This can lead to discrepancies. That's where data aggregators, like Reuters, are vital. They collect quotes from many sources and try to create a composite view. Still, the book notes you can find weird anomalies sometimes.
And the bid-ask, spread that cost of crossing from buy to sell, that's a constant factor too.
Absolutely fundamental. For a long-term investor, the spread might be noise. For an HFT firm making tiny profits per trade, the spread is a major hurdle. It's a direct cost.
Yeah.
The book even mentions the bid-ask bounce, the price naturally flicking between the bid and ask. Algorithms need to account for that bounce so they don't get faked out by noise. They sometimes filter the data to smooth it out.
It sounds like they're analyzing not just price and volume, but even the time between trades or, quote, updates.
Yes, exactly. They use duration models, trying to figure out what influences how long it takes for the next quote to arrive or the next trade to happen.
What can that tell you?
It can reveal information, especially maybe in stocks where short selling is restricted. Seeing how quickly quotes arrive might give clues about buying or selling pressure. They also look at time between price changes of a certain size or time between volume chunks.
Really digging into the finest details of market activity. The book also talks about trading on market microstructure. What's that about?
This is where they analyze the limit order book itself, that list of buy and sell orders waiting to be filled.
Uh-huh.
They look at the different types of traders potentially interacting there. Are there informed traders who might know something, value traders, or just liquidity traders providing or taking liquidity, maybe less informed? The aggressiveness of an order, like slamming a big market order versus patiently placing a limit order, can be a signal.
So trying to read the intentions or information behind the orders.
In a way, yeah. They also look at market maker models. Market makers face inventory risk getting stuck holding stock they don't want. The bid-ask spread they quote is partly compensation for that risk. The book even touches on using Bayes' rule, a statistical method, to update probabilities about events based on incoming market data.
And the flow of orders itself, just the sheer volume of buy versus sell orders hitting the market, that's informative too.
Hugely informative. The book cites studies like one by Love and Payne on currencies, showing that order flow can explain a big chunk of how information gets into prices, especially around news events.
Which links back to that event trading strategy.
Exactly. This leads right into event arbitrage, trying to profit from the predictable or sometimes unpredictable market moves right around news releases.
So predicting the direction or maybe even the size of the move.
Both directional forecasts up or down, or point forecasts where exactly will the price go. They apply this to company earnings, industry news, and those big macroeconomic announcements we talked about. The book gives an example of trading the US dollar versus the Canadian dollar based on US inflation data, and includes sample calendars of typical news releases and how different news tends to impact specific currencies.
It seems like macro news really sends ripples everywhere.
It does. Big impact, not just on currencies, but equities, futures, volatility spikes around announcements. The book cites a whole bunch of academic studies confirming this. Even things like real estate investment trusts, REITs, can get moved by macro news.
Okay, we covered event arbitrage. What about statistical arbitrage, StatArb, in HFT?
StatArb is about finding perceived mispricings between related securities based purely on statistical relationships you observe in the data.
Okay.
But, and this is a big but the book emphasizes, there's a real risk of finding spurious correlations patterns that look real statistically but have no underlying economic reason and might just disappear.
So you need more than just a correlation.
Ideally, yes. They talk about fundamental arbitrage, where the StatArb strategy is actually grounded in some economic logic.
Can you give an example of a common StatArb strategy?
Sure. Pairs trading is a classic. Maybe trading two classes of stock from the same company that should theoretically move together but temporarily diverge. Or market-neutral strategies where you try to cancel out the overall market risk and just bet on the relative performance of two stocks.
Long one, short the other.
Exactly.
Yeah.
Could also be liquidity arbitrage, or even exploiting information spilling over from large-cap stocks to small-cap stocks. In FX, a basic one is covered interest parity, exploiting tiny deviations from the theoretical relationship between spot rates, forward rates, and interest rates.
So finding these statistical links and betting, they'll revert to normal. Now, with all these potential strategies, how do HFT firms decide which ones to run and how much capital to put into each?
Right. That brings us to portfolio construction. They use frameworks like mean variance optimization, the classic Markowitz idea of balancing expected return against risk, measured by variance or volatility. But crucially for HFT, transaction costs become a much bigger factor in those optimization models than for a long-term investor. They have to explicitly account for those costs. They also need to think about things like asymmetric correlations, maybe assets move together more closely when the market's falling than when it's rising.
Complex stuff. And before they let these models loose with real money, they have to test them rigorously, right? Backtesting.
Oh, absolutely critical, non-negotiable. Backtesting means running your trading model on historical data to see how it would have performed in the past.
Does it actually work?
Exactly. Lets you estimate potential profits, drawdowns, risk levels. They talk about in-sample testing on the data you used to build the model, but more importantly, out-of-sample testing.
What's the difference?
Out-of-sample means testing on fresh data the model has never seen before. This is crucial to avoid data snooping bias.
Meaning the model just got lucky finding a pattern in the specific historical data you used.
Precisely. You need to know if it generalizes to new data. They use metrics like mean squared error, MSE, mean absolute deviation, MAD, and trading strategy accuracy, TSA curves, to evaluate how good the model's predictions were in the backtest. And because markets have patterns within the intraday seasonality, the book stresses you need to backtest over several years of tick data to be confident.
So really intensive testing to make sure there's a real edge, not just historical luck. Okay, we've covered a lot on the landscape and the methods. Let's talk about actually implementing these HFT systems. Sounds like a massive tech challenge.
It absolutely is. The book mentions a formal model development lifecycle, but yeah, building the actual trading system is complex. It starts with planning what should it do, what's the budget, then analysis, figuring out the detailed requirements, then design, breaking it down into software modules, then implementation, the actual coding by engineers, followed by tons of testing. And finally, production and ongoing maintenance, constantly tweaking and fixing.
And how do all these different systems, the HFT firm, the broker, the exchange, talk to each other so quickly? The book mentions a specific language.
Yes, the Financial Information Exchange Protocol, or FIX. It's basically the standard language for real-time financial messages. It started back in '92, and now it's pretty much universal for communication between brokers, exchanges, institutions, clients.
Like a universal translator for trading messages.
Pretty much, yeah. The book shows a sample FIX message, explaining the key parts message type, who sent it, who it's for, a sequence number to keep track. It provides that necessary structure for high-speed electronic communication.
Okay, so FIX handles the communication. What about actually turning a new system on? You can't just like flip a switch and hope for the best, can you?
Definitely not. Deployment is usually staged. First, that rigorous backtesting we discussed. Then comes paper trading.
Simulated trading.
Exactly. Running the system in the live market, receiving real data, making trade decisions, but using simulated money. This tests how it performs in real-time conditions without risking actual capital. You see if its live performance matches the backtests.
Makes sense.
If paper trading looks good, then it moves to live trading with real money. But even then, there's always human supervision. People watching dashboards, monitoring performance, ready to intervene.
So humans are still in the loop.
Absolutely. They usually set predefined boundaries, maximum loss, maximum positions, etc. If the system breaches those, or something unexpected happens in the market, a human trader can hit the kill switch. It's a crucial safety net.
Okay, good to know there's an off button. The book also flags some common problems in implementation. Time distortion caught my eye. What's that?
Yeah, that's a subtle but important one. Time distortion happens because the historical data used for backtesting isn't quite the same as the live data feed. The rate at which quotes arrived in the past data might have been limited by the recording system back then, or how many instruments they were tracking. The live feed today might be faster or slower, or arrive in different bursts.
So the timing isn't perfectly replicated.
Exactly. Plus, in a live system, you have network latency delays between the exchange or broker sending the data and your system receiving it. And then your own system takes time to process each quote.
Right.
If quotes arrive faster than your system can process them, you can get queues building up, maybe even data getting dropped. Even simple things like writing a quote to a log file take tiny amounts of time that add up. This difference in timing the distortion can mean the system behaves differently live than it did in the backtest.
That's a really tricky detail.
There's
And I guess that makes thorough testing even more vital.
absolutely critical. The book emphasizes different kinds of testing. Functional testing does each piece work as designed. Integration testing, do the pieces work together correctly? Regression testing, did our latest change break something that used to work? And recovery testing, if the system crashes or the network drops, can it restart properly without losing data or messing up positions?
You really have to try and anticipate everything that could go wrong, which leads naturally into risk management. With this much speed and automation, managing risk must be job number one.
It's paramount. Yeah, the book has a whole chapter on it. It boils down to 3 key steps. Figure out your risk goals, measure your risk, and then actively manage it.
Okay, how do they measure risk in this kind of environment? It seems so fast-moving.
They use a mix of tools. Statistical models are common. Value at risk, or VAR, is a big one.
They are, right. Heard of that?
It estimates your potential maximum loss over a certain period at a certain confidence level. Say 99% confident you won't lose more than X dollars tomorrow. They talk about different ways to calculate VAR, like parametric VAR, and also expected shortfall, ES, which asks, okay, if things do go bad, what's the average loss in that bad scenario?
Looking beyond just the threshold.
Exactly. But they also know returns aren't always perfectly normally distributed those fat tails again. So they might use modified VAR, MVAR, or look at tail indices to specifically model extreme events, or use techniques like parametric bootstrapping.
Yeah.
And for operational risks, things like system failures, human error, which is harder to model statistically, they often use simpler scalar models or do scenario analysis.
Their analysis, like, what if the internet connection
Yeah,
drops?
exactly. Thinking through potential operational failures and estimating their impact.
Okay, so they measure the risk. How do they actively manage it during trading?
Several key techniques. Setting stop-loss orders is fundamental.
Automatic exit points if a trade goes bad.
Right. If a position hits a certain loss level, the system automatically closes it out. They talk about simple fixed stops and also trailing stop losses, which lock in profits by moving the stop level up as the trade moves in your favor.
Sure.
Dynamic risk hedging is another one, actively adjusting positions in real time to offset unwanted risk exposures as market conditions change. And then there are process things. Regular reviews of procedures to catch potential problems, and closely monitoring the execution quality itself.
Stop losses seem like such a basic but essential safety mechanism in these markets. Now, once the algorithm decides to trade, how do they make sure the order gets executed well? Is that optimized too?
Oh yeah, execution optimization is a huge field in itself now, increasingly important for HFT. In the old days, you might just give your big order to a broker and hope for the best.
Right.
But algorithms now let traders try to optimize execution themselves, aiming for the best possible price while minimizing the market impact of their own order.
So try not to move the price against yourself. What kinds of algorithms do that?
The book mentions a few types. Trading aggressiveness selection algorithms. These help decide whether to use a fast market order or a potentially cheaper but slower limit order, balancing that cost versus risk trade-off.
Okay.
Dynamic trading strategies try to minimize how far your execution price drifts from some benchmark, like the average price over a period. And they even mention a specific one called the plus algorithm, which tries to maximize a sort of Sharpe ratio risk-adjusted return relative to a benchmark.
Interesting. So algorithms optimizing other algorithms. The book also mentions slicing big orders. Why do that?
Slicing just means breaking a large order into many smaller pieces and sending them to the market over time, or perhaps to different venues.
Oh,
Research suggests this can help hide your full intentions from the market, making you less visible, and can often lead to better overall execution prices and higher fill rates, especially if you're using limit orders. Less likely to scare the market, basically.
kind of like being stealthy. Makes sense. And once the orders are out there, they're monitoring the execution constantly.
Absolutely. High-frequency execution monitoring is typically a two-step thing. First, pre-trade analysis sets the baseline. What are the acceptable ranges for slippage, fill rates, costs, etc., based on current market conditions?
Getting expectations.
Right. Then, during live trading, the system continuously compares the actual execution performance against those pre-trade estimates and guidelines. If things start deviating too much, costs are too high, fills are too slow, it can trigger alerts or even automatically halt that strategy.
Constant vigilance, then. Okay, finally, the trade is done, executed. The analysis isn't over, though, is it? Post-trade analysis, especially costs, must be huge in HFT.
It's absolutely essential. Like we said, with lower frequency trading, maybe you make a big enough profit that transaction costs are just a small percentage.
Yeah, background noise.
But in HFT, where you might be making fractions of a cent per share, but doing it millions of times, those transaction costs can be the difference between profit and loss. They add up incredibly fast.
So what kinds of costs are they looking at?
The book breaks them down into transparent costs and latent costs. Transparent costs are the obvious ones. Broker commissions, exchange fees, regulatory fees, things you see on the statement.
Right.
Latent costs are sneakier, but just as important. Market impact, the cost of your own order moving the price against you. Opportunity cost, the cost of not getting your order filled when you want it to. And timing risk, the risk the price moves against you while you're trying to execute.
Market impact seems key. How do they deal with that again?
Well, slicing orders into smaller pieces is one main way to reduce it. The book also talks about how to measure market impact accurately, ideally when the market is stable before and after your trade. And when looking at broker commissions, it's not just the per trade fee, it's also interest on borrowed funds or short positions, market data fees, maybe even research costs bundled in. Different brokers have different structure.
So you need a full picture of all the costs. How do they actually measure the overall effectiveness, the total transaction cost?
They use concepts like the efficient frontier for execution, trying to find that sweet spot balancing cost and risk. A common metric is implementation shortfall.
eyeless.
Yeah, it basically measures the difference between the price you actually got versus the theoretical price when you first decided to trade, accounting for all those costs and impacts. They also benchmark their execution against market averages, things like TWAP, time-weighted average price, or VWAP, volume-weighted average price.
Comparing their average price to the market's average price.
Exactly, or even against OHLC, open, high, low, close benchmarks. Though the book rightly points out these benchmarks have limitations, they don't fully capture the difficulty or ease of trading at specific moments.
So maybe not the perfect comparison.
Not always. So another approach is relative performance measurement, looking at, say, what percentage of your buy order was executed below the VWAP or what percentage of your sell order was above it. How did you do compared to the overall flow during your trading period?
So a more nuanced comparison to what was actually happening in the market right then. It sounds like an incredibly detailed, data-obsessed approach to squeezing out costs and maximizing efficiency at absolutely every step.
You got it. In the high frequency world, every basis point, every microsecond counts. Understanding and managing all these details, the strategies, the tech, the risks, the costs, it's absolutely fundamental to staying in the game.
Well, this has been a really, really fascinating deep dive into this incredibly fast-paced, technology-driven world of high-frequency trading. It's crystal clear that success here demands just deep expertise in market microstructure, complex algorithms, solid risk management, and that obsessive post-trade analysis.
Absolutely. And what's really interesting to think about considering all this is where HFT goes next. Technology isn't standing still. Regulations are always evolving. How is this ongoing evolution going to keep shaping our financial markets?
Hmm.
It definitely gives you, our listener, something to chew on as you think about the future of finance and your own understanding of it all.